Good morning and welcome back to Almus Market Mornings, your daily dose of global financial updates. Tomorrow is an important day for financial markets when central bank meetings lined up and of course our own very own budget. Apart from this, there will be also a host of data that will be out. Ahead of these, the data released yesterday indicating a strong US labor market and an improved consumer confidence might be making the traders betting for a cut in March sweat. Good morning, JK. How are you reading yesterday's US data and what kind of stance do you expect the Fed to?
Good morning, Swaraj. Economic data continue to affirm the superior economic situation in the US and further reduce the market's expectation of a rate cut in March now, which is down to around 40% probability. We had as much as 89% probability at the peak. Now, the superior growth picture related to other regions, particularly Europe, has been stark because the GDP, employment, and consumer confidence, all in the US, has shown further improvement. Strong consumption level as depicted in GDP report, as well as the more jobs available in the economy related to demand, shows that record increase in policy rates in Fed has not really impacted the US. While situation in Europe, whose GDP numbers were published yesterday, was quite contrasting. In fact, Eurozone economy stagnated last year and underperformed rest of the world as former powerhouse Germany struggled with an industrial difficulty that has no end in sight, and particularly China's slowdown has affected them a lot. Now, the GDP in Eurozone was flat for fourth quarter as well, and it just avoided technical recession because last quarter they were minus 0.1%, and that was thanks mainly to a few countries like Spain and Portugal recording modest increase as well as in Italy. But Germany was really struggling, continues to struggle actually. The economic sentiment indicator also nudged down to 96.2 versus 96.3 in December. So that also shows the small increases in sentiment in manufacturing and services were actually offset by declines in all other sector. Confidence index was at minus 16.1 versus minus 15.1. Now contrast this with the US data. The number of jobs available in US appraised with a higher number of 9.026 million versus an upwardly revised 8.925 million in November. And at the same time, the quits rate, of course, dropped also, which shows that employees seem to be a bit cautious to keep their jobs. Now, the data is good for workers who have many options for taking up jobs, while the central bank will be definitely worried that this is adding to consumption demand, which will eventually possibly push up the inflation further. So it's one of course, the JOLTS data is one of the lead indicators to the monthly job data due on Friday. We'll of course have ADP numbers tonight, employment cost index as well, and then the challenger job cuts report tomorrow. We also had the consumer confidence in the US, again contrasting with the US, rising to 114.8 versus 108 that was seen in the previous month. Now, all this is to be viewed in the light of monetary policy that is in focus. The recent data from US is not supportive of an early rate cut by Fed, and according to me, in today's meeting, they are likely to express a data-dependent approach once again. Market will be looking for clues about timing of the first rate cut and also further indications about the tapering of the quantitative tightening program. So this is what we will look for from Powell's statements. In Europe, the data is still underwhelming. So one could, of course, take heart from the fact that they avoided a recession by reporting a flat growth versus contraction. But the inflation number tonight from Germany, as well as the one from Eurozone tomorrow, will be important. We did have an inflation number from Spain that was reported earlier yesterday. So again, the ECB's cautious stance is definitely kind of supported. The growth picture of the US and the standby, cautious stand by the Fed have remained supportive of the dollar. Yesterday's data in the Eurozone, which was slightly positive, could not sustain the gains for the euro. GBP, of course, is waiting for more clues on the economy and also on inflation in the coming weeks. Chinese yuan, and the Chinese markets have again reverted to their downward journey after the effect of RRR cut has really waned, and we really need a very strong measure on the structural side from the Chinese to see any sort of sustainable improvement in the markets. Now, looking more specifically at other markets, yields rose strongly in the first week of this month, but subsequently we've been seeing them drift lower again, and any upticks have seen the bonds being bought aggressively. This happened despite a strong set of economic numbers from the US. We are now, for 10 year, we are at 4.02, and that's as much as almost 18 points, 20 points lower from the peak that it has seen recently. On the stocks, they were mixed. Solid economic data and its impact on rates, along with concerns about earnings miss from one of the large companies has been on the limelight. 7 companies like Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla, they all have their earnings report coming up, and market remains a bit nervous that they could miss the numbers, and that's the reason why we saw the stock market consolidating. Although S&P 500 made another new high, it ended slightly on the lower side. The Asian markets are not really looking very healthy today. Particularly China is down 1% again, and Japan as well is down. Overall, on the currencies, I feel dollar is still remaining well supported, and it can get a further boost from neutral statement from the Fed. Meanwhile, not so encouraging news from the geopolitical side. Iranian-backed Houthis have stated that they are ready for a long-term confrontation with the US and UK. And of course, they have not, they have not defined how long that will continue, but then they are saying that they will keep continuing to attack the ships. That's what it says. On the Indian side, of course, as you said, we wait for budget tomorrow. The fiscal picture, the borrowing program, and any boost further to consumption and investments are what we are looking for, although major announcements will be avoided in this interim budget. Meanwhile, IMF in the World Economic Report published yesterday have shown India's GDP to grow by 6.7%, which is higher than the 6.3 that they had forecast in October. Now, while this is lower than what the National Statistics Office as well as RBI have been projecting for India at 7% and 7.3%. It's still, comprehensive commentary on the global situation that confirms that superior growth prospects of Indian economy relative to other economies is continuing. And then the IMF also shows the global growth rate to pick up at 2.1% in 2024 versus 1.5% that was projected earlier. And German GDP, of course, is forecast to come at 0.5 versus 0.9%. So it kind of a mixed report, and the US GDP growth is also expected to pick up to 2.1% from, sorry, the earlier number which I mentioned was about US GDP growth at 2.1, 1.5%. And for global economic growth, it's expected at 3.1 versus 2.9%. So IMF report is, of course, a kind of broad-based assessment by the global institution, which is an indicative of how the world is moving towards the growth. So yeah, our immediate focus is on the monetary policy by the Fed and budget from India, and possibly we get better volatility, particularly in the rupee post these events. Thank you.
Thank you, JK. And just quickly summarizing ahead of the Fed meeting outcome tomorrow, what things to look out for would be the update on quantitative tightening as well as any indication on rate cuts. So that's what markets would be looking at. And US rate cut expectations for March are down to 40% probability as consumption continues to hold up despite such interest rates. In contrast, Eurozone has been struggling, and the sick man of Europe, as it's commonly said, Germany continues to be a laggard. Chinese economy continues to be in a slump, and strong stimulus package is required. And US stocks will be in limelight as earnings for major companies will come out in the following days. For rupee, of course, we apart from the FOMC, we have the budget day tomorrow, which would be important. Uh, and so we continue to be in a range, and possibly tomorrow, after so many events, we can expect a bit of volatility. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.